I'm 𝘱𝘭𝘰𝘷𝘪𝘥, president of 𝘕𝑗 Lawyers. We help business owners with their succession planning throughout Ontario. Today, I'm going to talk about the first 3 things that you want to look for when someone is offering to buy your business. So let's say you're getting towards retirement age, and rather than continue operating your business or leave it to your children, you want to sell your business to a third party or even a competitor. So you speak to a potential buyer, and the potential buyer puts in front of you a purchase and sale agreement. Again, you want a lawyer to look it over, but here are the top 3 things that you want to look for when you're looking at the business terms of the deal. The first thing is not price. A lot of people think that you should be looking at price. However, price is not what you should necessarily look for, as are the payment terms. Someone can offer $10 million to buy your business, but if the payment terms are not cash on closing, the payment terms could be, I'll give you $1 million on closing, and the rest, I'm going to pay it over time in monthly payments, for example. Or I'll pay you $10 million and it's all based on a performance. In other words, if your business does not perform, then the purchase price is reduced over every month that it's not performing. So again, it's very important not to look so much at price as you look at the terms with which the price will be paid. The second item that is very important to look at and causes a lot of disputes is something called the working capital clause. This is a clause that usually says that you have to leave the business with a certain level of target working capital in order for you to sell it. And if you do not leave it with that level of working capital, either the buyer can get out of the deal or they will again reduce the purchase price. So what is working capital? That is a certain level of assets, money, inventory, receivables, and so forth that you're leaving within the business over your typical liabilities. This is usually a made-up average number that is done after the buyer does an analysis of your business, and they'll set a target. And usually there's a lot of back and forth between what that target is and whether or not you've actually left that number in. It's very complicated, and it's important that you speak to an accountant or a lawyer or some advisor to help you through this particular clause. But I'm bringing it up in this video to explain that this is a particular clause that is used to reduce the purchase price even after you've closed. The third and final point that you want to look for when someone's offering to buy your business are the conditions of closing. Sure, they're offering $10 million for your business and you have enough working capital, but what are the conditions or covenants that you have to abide by in order to close on this transaction? So a condition is something that you need to make sure that you can accomplish in order to make sure that the transaction closes. A common condition is landlord consent. You have to be able to go to your landlord and make sure that they consent to the new buyer coming in. Maybe a condition is an employment agreement that you have to sign or your management team have to sign in order to close. And this agreement will require covenants. What that means are promises after you close that you have to fulfill. There could also be a non-solicitation clause or a non-competition clause that you have to sign in order to complete the transaction. So look at the conditions that you want to satisfy in order to close the transaction and see if these are things that you can satisfy or if you want to push back. The initial part of the negotiation is where you push back on all of these terms. The payment terms, it's not just the price, it's the payment terms, the working capital clause, and the conditions that you are required to close the transaction. Thanks for watching, and if you have any other questions, and if you like these videos, please click like and subscribe.